Sir, I understand that this motion, which seeks an increase on the limit on the face value of government debt to 1.5 trillion is, despite its staggering headline number, somewhat routine. And we are all, truth be told, rather tired after a long day in Parliament. I had previously spoken on an analogous motion at the beginning of 2021, where I stressed how government borrowing more need not be detrimental, especially if economic conditions are favorable and if invested well in furtherance of our national objectives. I stand by that position. Still, it's worthwhile looking at how the economic environment has evolved dramatically since and what this could imply for this particular round of a proposed increase in the debt limit, as well as our implied interest burden. As the world entered into 2021, much of it was still teetering from the aftermath of the global recession brought about by the COVID-19 pandemic. Economic activity had plunged to a low of -3% in 2020, the lowest in half a century. Lockdowns were still routine in many countries, and unemployment rates remained very elevated, 6.6% globally, the highest since 1990, and surpassing both the Asian and global financial crises. Inflation was still very quiescent, however, averaging 1.5% worldwide at the end of that year. Owing to overall economic weakness, interest rates at the time remained remarkably low. This was what prompted my call at the time to lock in the favorable borrowing rates and to take advantage of higher multiplier effects that would have been present then to expand public investment in our hard and soft infrastructure, thereby stimulating growth. Now, this is no longer the case today. World inflation started to rise steadily in 2021 to 3.2% before peaking at an eye-watering 8% the year thereafter. In Singapore, the cost of living took off in 2022 as well, reaching 7.5% in the third quarter, which was the highest since the 2008 financial crisis. Thankfully, our economy has since rebounded. Today, the unemployment rate is around the historical averages of the past 2 decades, and while prices are still high and real wages have yet to fully catch up, the inflation rate has stepped back, down to 2%. It is in this renewed economic backdrop that I'll offer 3 brief thoughts about the proposed increase in the debt limit. While I do not view these concerns as sufficient cause for objecting to the motion, it would nevertheless be useful to get some clarity on the matters raised. First, the increase in the limit represents the highest increase over the most recent 5 instances. In November 2009, the increase was 70 billion from the original limit of 250 billion. The increments in April 2012, November 2016, and January 2021 steadily rose, amounting to 170, 200, and 270 billion. Even so, the present increase calls for 450 billion of an increase, a disproportionately larger 2/3 relative to the prior quantum. The increase is also significant as a share of our economy. Between 1992 and 2021, a 3-decade period that saw the limit increase 6 times, the share of debt to GDP has always hovered between 110 and 165% of output. This round will bring the total burden to 225%. Now, even taking into account a generalized increase in price levels, and granted that the borrowing now enfolds both bills under the Local Treasuries Act, or the LTBA, and longer duration bonds under the Government Securities Act, or GSA, this is a sharp increase. After all, the limit for Treasury bill increases had only been raised once in recent memory, by 10 billion in 2004. Put another way, were we to take the debt limit from 3 years ago at face value, adjust that by inflation, and apply an inflation-adjusted T-bill amount, we would still arrive at a revised limit of a little less than 1.1 trillion, rather than the 1.5 trillion being asked for today. Hence, while I appreciate that the debt issued are for market benchmarking and financial development purposes and are constrained in terms of how the money raised may be spent, some explanation for this discrepancy seems warranted. Now, Minister Chi, in his opening remarks, mentioned that these are attributable to SSGS due to wage increases and CPF enhancements. May I seek a clarification on how much of the future share of anticipated growth is due to CPF changes versus that for financial development? Second, given the contemporary interest rate environment, the yields we'll need to pay will correspondingly be higher. The yield on 10-year govies in January 2021 was a mere 1%. In early November, rates were closer to 2.8%. Similarly, short-term yields were less than 0.5% then, compared to 2.7% now. On balance, the interest repayment burden is around 3 times higher than what it would have been a mere 3 years ago. Would the government be able to explain how it plans to limit the fiscal impact of this elevated interest repayment stream? Perhaps the proceeds raised will be transferred to our sovereign wealth funds for management, in which case the hurdle rate will likely remain manageable, given how nominal returns have also moved up in the interim worldwide. Regardless, a narrower spread between SWF returns and borrowing costs will mean, at the least, less by way of surpluses to be returned to the Ministry of Finance. Hence, I believe it's valuable to have a handle and have on record how the government plans to manage this revised interest differential, just so as to reassure Singaporeans. Now, my third and final point has to do with the ultimate purpose of issuing, whether the ultimate purpose of issuing such debt is actually being met. The stated objective of the SGS, Market Development Securities, is to, and I quote, develop the domestic debt market, end quote. But exactly how much our record issuances have translated into actual, usable, investable funds for our companies on the ground remains questionable. After all, domestic credit to the private sector, a standard and widely used metric for gauging the depth of financial development, stood at around 130% of GDP in 2020, significantly lower than comparator economies such as Hong Kong, Japan, and South Korea. The equity market capitalization share in Singapore has also languished relative to other global financial centers, such as those of stock exchanges in New York, Tokyo, Hong Kong, and London. This means that Singapore has succeeded, certainly, as an international financial center, but it's more questionable whether it has succeeded as a globally competitive financial market that serves its economy. Put another way, as much as we have succeeded in being an intermediary of global saving, less of it appears to have made its way into our domestic economy. Is this a problem? Well, not if you believe that a thriving financial industry will eventually trickle down to our workers and businesses. But if you worry about the credibility of trickle-down economics and wonder if our vaunted status as a global financial hub has benefits to the common man and woman, then you might justifiably question if the continued drive for expanding our debt limit to foster market development has borne much fruit in terms of tangible improvements to the welfare of our people.